It's usually something I forget. Well, it looks like I'm going to stop sharing for a moment and stop recording as we'll start again here. And can you see my screen now? It says I'm screen sharing. It says excellent teamwork.
Yes.
Okay. I think you'll find this interesting. This is a tire change in a major high performance race car race.
Professor, you're on mute.
I probably didn't have much to say anyhow, but a little bit of music for you in that video. So real quickly, let's catch these names again. Deshaun Johnson, Daisy Martinez, Crystal, thank you. And yes, that's it. So now I hope this is going to be a lot easier than what I've just gone through to try and get that thing on the screen, that little film. But we're going to I can't believe it, but I have somehow managed to screw up what I was going to show you. So we'll try this again. All right. So what I'm sharing here is Industry 94. This is from my perspective as an instructor. And I want to go right to the reports. So this is stuff that you have. I changed the size and color of my cursor so that it would be easier for you to see. It's almost overbearing. But we're going to look at the reports for Industry 94. And this is a sequence that you'll go in as well. First thing that we want to look at, just because we want to see it, is our footwear industry report. And frankly, this doesn't tell you a whole lot because your activity, uh, this is not even going to get interesting until about year 18. And then at that point, you're going to have that desire to find out where you are. And the lower half of it tells where you are game to date. But again, this is not really something of significant interest to you because there's not a whole lot of information there. The next thing you're going to want to do is take a look at the competitive intelligence report. And actually, I want to go back to the menu for this and look at some of the subsidiary things. But before I do that, because now we're going to go into it in some depth, I want to find out if there's anything that is pressing from your perspective. Are there any things that you want to ask about? You got it?
Yeah, I had a question, Professor.
Okay.
Basically about the practice decision 11. I realized we have to look at the previous year's reports and I guess make estimates on what numbers we want to choose, but I had a problem like coming up with what numbers to choose. I was kind of
that's particularly difficult when you're at ground zero. So
right.
you're going to just have to make some kind of a guess. And, you know, I might have tried, say, 4 or 5% increase for sales versus the preceding period. And you had all of the financial data for the company in year 10. And who was that asked that question?
Angelica Stewart.
Okay. Okay, Angel. Good, thank you. What so does that give you a little bit of help that you can always go back and look at, you know, what the financial statement says you did the last time?
Right. So I would basically just look at previous financial statements and I guess make a decision that would be similar to what I've been seeing for the past however many years it goes back.
Yeah,
Okay.
that's about right. But the actual growth, Angel, as you go forward, is not going to be determined by the game. The game may say, okay, we're going to take the marketplace up 2 or 3%, but if these students get aggressive, they can increase it at the rate of 5 or 6%. If you do a lot of advertising and a lot of promotion, get some good celebrities and put them to work, you can grow. You can make the market grow. So that's what makes it interesting from my perspective, because it's different for every time I do this, because the personalities of the people involved are different. Okay, yes. Yes, next question.
For me?
Somebody just started.
Okay. I'm not sure if anybody else did. My quick question was, you had mentioned that it would be a good idea to print something out. And I was just, if you can go over that again.
Yes, I'd print out every report that you got.
Okay.
And that means you're going to end up with a notebook that is going to be about 1 inch thick before you're done.
Okay.
And that, you know, part of this is somebody who's old school looking at things that way. You are so much better with the use of computers. I print out every email I get before I read it. And I hate to say that I'm not old, but I find it more convenient to do it that way. You may be able to do it directly from the computer, but you've got to have the ability to get at all the reports every round so you can make important decisions. Now, one of the other things, this is kind of a non sequitur, but one of the other things, I put out a request that you buy case studies, and I sent a link to Harvard Business Review or Harvard Business School Press, and there's 4 of them out there that you have to buy as a pack. They're $17. If you get it done before tomorrow night, you get 10 points towards your participation grade. If you go to the next day, you don't get any. And that's non-negotiable. So I have 107 students in this class, in all, the 4 sections. And I have had 10 purchase the case studies. And in the next 2 or 3 weeks, I'm going to be making assignments from those case studies. And it's going to be pretty tough unless you got them. You're going to have to buy them. So, you know, skip the caramel macchiato at Starbucks this week and save up the $17. You're going to have to do that by tomorrow night, though. All right. Yes,
Did you send that on email or is it on Blackboard?
it's on Blackboard as an announcement. That seems to be the best way for me to communicate. It was sent out on September the 15th. And you know, if you go just, everything there is chronological. So if you just work your way backwards, you'll find it. And I think I
Okay.
actually sent out a reminder today. So that'd be the first announcement. And that seems to be the most efficient way to get stuff to you. Okay.
Okay, thank you.
All right. So I'm going to go down and this set of reports. The footwear industry report is actually subdivided into a number of different things, and we're going to use all 8 of those before the day is over. But what I want to go to first is the competitive intelligence report, because I've indicated to you this is the one that gives you the most information at your fingertips. So this is what this looks like for your industry. We've got 3, 6, looks like 9 companies there. I'm going to be dropping company I because there's nobody in it. But the game will not let me do it until after you finish your decision 12. So the decisions that were made in year 10 for team I are being made in year 11 and year 12. So you'll see that the wholesale sale price will remain at 48 and the internet price will remain at 67. Okay, what do you all notice about this report that catches your attention? Obviously, your particular team is going to catch your attention, but what do you see there that's worthy of study?
Negative 256. So that means that they didn't have the pairs on demand, and then somebody else basically stole their marketing.
Yeah, so it means that they were sufficiently effective in their marketing mix that given the level of production that they made, they actually ran out of stock. There was more demand than they expected. And so you ended up, and I know that was Androids that said that, right?
Yeah.
Okay, so the negative 256,000 pairs. And as I said, what happens when the customer comes in, if they don't see what they want, they buy another brand. And so you can see that the other guys got the pluses on this, so that when you get over to the average, everyone was able to get shoes. It's just that company C and company H wasted money promoting their product and giving the sale to somebody else. Now, this isn't too bad for the, you know, this is not really a significant thing at this point. This is the first go round. But if I saw that in year 17, I may give you a call and say, hey, what's going on? How come you're getting in that position? Now, Andres, I'm going to move the cursor up here to see what it says in the private label segment. And there you see something that's a little more disturbing, because you see Team C ended up selling 208,000 pairs out of that, what they could have had at 256,000 had they been making their branded product. And they obviously did have capacity to do that. They
Yeah,
sold
that's kind of bad because private labels basically you sell them at super low prices, so you don't want to do that.
Yeah, so they got $24 less per pair for that 208,000 pairs. And that's the thing that really grinds on you, because whoever's doing the marketing or whoever's doing the production, it could be a problem in either area. This is, you don't want to see this. Now, all the teams that were bidding either in the private label, just to camp on that for a couple more, another 30 seconds. Everyone had at least a 3.0 quality styling SQ rating. And Team D kicked theirs up to 3.3. Team C had a 3.2. That's very satisfactory. We'll see as the game progresses that SQ rating will go up for private label. And what it'll be reflecting is a higher SQ rating for the industry as a whole in their branded products. And if you look up in the wholesale segment, you'll see that most of you did a little bit of curve fitting to get yours up there at a higher level. And every one of those numbers is very satisfactory at this point in the game. That SQ rating that runs between 6.6 and 3.7, those are all very satisfactory for the market at this point. And you notice that the average, if we go over to the right, the average here is 4.8. So the marketplace is kicking the quality up because it was 4 at the beginning of the first of year 11. All right, anything else that you see there? Anything else catch your attention?
Well, the amount of brand advertisement that some of them people have done.
Okay, and AJ, I've been calling you Andres, but I know on my cheat sheet here it's AJ, so I'll try and be better at that. Team A spent $21 million on advertising, and when you look at the other things that they did in their branded product, their wholesale segment or retail segment, if we can use any of those three terms interchangeably, they ended up with a 15.8% market share. By contrast, Team F only spent $500,000 on advertising, and they still came out okay. They had 11% market share, but they did it with a lower price. Team A was able to sell theirs at 58. Team F is selling at 48. And I'm going to make a prediction that no matter what Team F does for year 12, that they will lose dealers. That retail outlets are going to desert them. And the same is going to be true with Team B, where they didn't put anything into dealer support, retailer support. And that's also true of Team E, that those dealers are not very happy because they're not getting any promotion dollars to sell their product. Does anyone have any comments on that? Now, I indicated to you in one of our earlier lectures that I'm looking for a wholesale price that could be marked up at least 40% so that wholesale or retail guy is able to make a profit when he sells against our internet pricing. And all of you have given plenty of margin there. That's fine. That's going to work out. Notice that we run between 200 and 349 different model availability. That's model styles. And I would bet you when we look, and I have not looked at it, that we're going to see that there's a higher reject rate for Team A than there is for Team D or G or H or I, or B. A and C are going to have one of the highest reject rates because they're making more model changeovers to cover more different model styles. And that's a trade-off that they've chosen to make. Maybe they didn't know they were choosing to make it, but that will reflect itself in production statistics, and that's at the expense of or in favor of the marketing manager who's able to sell his product better because he's got more arrows in his quiver. Okay.
Professor, I have a question.
Good.
Would you mind going over the gain and the losses? Like you said, the what was in yellow. Can you repeat why
Okay.
what they did to make it negative and what they could do to fix that?
Okay. Well, first of all, the marketing mix they had dictated the line at the bottom that shows pairs demanded. That was the basis on which they presented their offering to the public. And that was made up of what got that was the brand advertising. Well, first of all, the model availability, wholesale price, just run right down the list. Wholesale price, model availability, brand advertising. I'm going to skip over rebate because I don't think that's a big deal. I'm going to skip over delivery time, which I don't think is significant for us at this point of the game. The retailer support is very important. That will dictate in the ensuing rounds. And with whom am I talking? Who asked the question?
Sorry, I was on mute.
Who, what?
Trisha.
Huh? Trisha?
Trisha.
I gotta find you on here. Say it one more time.
My name?
Yeah.
Trisha Daves. Daves. D-A-V.
Okay, Trisha, yeah. That's what I thought you said, and then I thought you changed your name.
No,
But-
I think my internet is horrible. I'm sorry. It keeps cutting off
Okay.
to speak with you.
Well, just don't judge me too harshly if I keep asking questions.
I forgive you.
Thank you. I feel blessed. Okay, so the combination of those things suggested that the pairs demanded would be, in the case of Team A, 2,890. In the case of Team E, for example, it was 1,990. It's the different mixes in marketing mix that are going to determine what that demand is. In the case of Team A, B, D, E, F, G, and I, the amount produced, which was based on some kind of a forecast, and I think it was Angel who was asking, how do I get a demand number? When she grabs the demand number for year 12, that's going to help dictate what the production people are going to produce, because they want to produce the same thing that she's saying the marketplace will absorb, right? You agree with that, Angel? Angel, you didn't go away, did you?
No, I'm here. Sorry.
Okay, you agree with that?
Yeah.
When you finally grab a number, you say, well, we want to try and hit this number. That's going to dictate what you're going to produce.
Gotcha.
Thank you.
Thank you.
Okay, so Trish, in looking at this, what happened is the actual demand for Team A exceeded their planned production, and they were able to draw some inventory that they had in stock, and they were able to sell above their forecasted production, the forecasted demand. In the case of Team C, their marketing mix dictated 2,262, and they just didn't have enough. Their production staff had not planned enough production, and so they ended up with a negative number. So the actual sales, you'll see at the bottom there that says pairs sold for team C was 2,006,000, and whereas they could have sold 2,262,000 had they had the proper balance between marketing effort and production plan. Does that explain it, Trish?
Absolutely. Thank you.
Okay. Now, we know in this report that there's some things down at the bottom. There's this material about private label, which I'm going to ignore for the time. And then I'm going to look at the bubble chart at the bottom. And, you know, normally I'd say I would ignore this, but there's very good spread here. Some of you had small demand, and, you know, these are preliminary numbers here for first round, so they really aren't indicative of your brilliance or the way you're fumbling along one way or the other, because this is still early, and I've encouraged everyone to take risks. Try something and see if it works. But clearly Team A is well balanced in terms of their breadth of product line, and they also have had a high price SQ rating. And there's a little overlap there with Team C, but by and large, those two teams are up by themselves, so they're not going to be competing directly with one another. That's good. Now, I've concentrated here just on North America. It also says that this is company A, but this is a comparative, it's an industry report. So a company B, or let's take company D, it's going to be exactly the same. It's the same report for everybody. And let's just, for kicks, let's see how much the marketplace balanced out for the other areas. And I always put most of my effort looking at North America because it's the largest market. And you can see now in Europe, Africa, Team A, which was in great shape there in North America, they actually ended up with a negative position. Asia Pacific, looks like it's very well balanced all the way across. These are trivial numbers, 60 and 11. That's not even worth bringing up in the management meeting. And then Latin America, again, whoa, what happened to Team A there? They had a significant shortfall. Got that, Trish?
Yes. Yes.
But somehow their marketing mix projected demand. There was a lot more demand out there, but they didn't produce enough. Or in this case, because it's Latin America and they don't have a production facility, they didn't ship in enough for it. So now I'm going to go back to these reports. Now, I don't look at the scoreboard. As I said, that doesn't mean anything until about year 18. I don't look at earnings per share, return on equity, stock price, anything like that in the early rounds either, because it's meaningless. Credit rating, it's going to come out at the end, and I expect your credit rating to go down before it goes up, because I do expect you to be building additional facilities. And as you do that, you're stretching your borrowing ability. You have to borrow the construction loan, and you have no income coming in against that construction loan. So once the facility is up and running, your credit rating will go back up. I'm not concerned about bonus points. I am concerned about industry overview. And there's some interesting things here that we can find from this report. This tells us the place I look at is the demand forecast, and we'll be looking at some supply as well. Excuse me. You have there a 3-year forecast on demand for branded product right here, and for private label. And you could see that this is broken out by each of the 4 regions, and we can see the total expected demand. And that's for 3 years in a row. This is then summarized down below, some supply demand analysis. And I always find this intriguing because here, the branded product forecast, which is from right up here, just brought down, and the private label right here, just brought down, are compared. The sum of those is compared to the actual global available supply. And there's always, and this shows the potential year 12 production, which is 120% of your rated capacity, plus the available inventory you've got in the pipeline. So if, you know, you had to, we ended up with some kind of a catastrophe in the economy, you could crank out 97 million pairs against a demand of 86 million. If we went to war, for example, and they had to make a lot of extra pairs, that's how much slack is still in the system. And they always give you an analysis. And I disagree with their analysis here. It says potential global supply at maximum overtime in the incoming year is 13%. And that is, I don't feel real uncomfortable with seeing that kind of a number, but they're suggesting that this could force prices down because everyone wants to sell out their capability. And how do you sell out your capability? You drop the price. So we may see some price competition in year 12. Got that? Do you understand what I'm saying?
Yes.
Okay. So then I'm going to go back. This is as far as I want to go. There's more information in this report, but I'm going to go back and look at the financial statistics. And this is a 3-panel report. And this shows income statement. It shows selected balance sheet information, and this is all good to look at. Team C has made a stock purchase. No, it's a stock sale. I'm sorry. They've beefed up their equity by selling an additional 100 million in shares. And so I think that's a wise thing to do. It puts them in a position where they can go out and build their factory without having to worry too much. 2 of the other teams did actually purchase some shares. I don't understand exactly what their rationale was for that. But you can do that as you go along. You can pick up your shares, and this will improve your return on equity if you do that. Now, this is where it gets interesting for me, the selected financial statistics. And one thing I look at is this line right here, days of inventory on hand, because I've said before, and I know this will be true, that you're going to let your inventories get out of hand. You were at 11, and we can go back and I can show you where you were last year. 11 days. And in this 1 year, we've gone up from 11 days to up to 53 days. So it can get out of control real quickly. So bear that in mind. You want to, this is a number that I look at every time around because I don't want to let that get out of control. And I suggested someplace between 25 and 30 days is a pretty good number. Now, another thing that I noticed here is Team C, Team F, and Team I. Well, Team I doesn't count because there's nobody there. But C and F did pay out dividends. And I'm going to ask the question if somebody from one of those two teams would tell me why they chose to do that.
I honestly wanted to see what would happen.
Okay, who was that? Who's was making that decision?
That was me, Josh Berlin.
Okay, Josh. And what did you think about the result? What did you expect if you were to take a guess as what the expected result would be? What did you think would happen?
I think I would get more investors.
Okay, and that means that there's going to be more demand for your stock,
Yes.
and that means that your price on your stock should go up.
Yes.
Okay, and that's a very logical position to take. And what you're going to find is if you decide that you want to issue dividends, your best benefit is when you do it multiple years. So let's say we did it in year 17 and year 18. Year 18, you're going to get more of a pop than you did in year 17 for issuing some dividends. If you issue dividends and then drop back, supposing you issued dividends in year 17 and then discontinued in year 18, people will really treat you like a hot potato. So you'll get penalized more than you gained from the distribution.
So now that we pay dividends, it's smarter to keep paying dividends after each year?
Yeah, once you get started on it. Now, in your case, you did you get a pop in the price of the shares?
I'm not entirely sure. Just like Josh said, I was doing it just to see what happened, but it said that that your company spent $1 of dividends in year 10 when I was looking at it as well.
Okay, so your team,
I'm Team C.
Team C. Okay, you got a little pop there. Team A earned theirs the hard way. They made money. You got some benefit from it for doing that.
Hmm.
So now, but I make a recommendation, Josh, that when you get in the real game, you may want to wait until out about year 15 or 16, where you got your end goal in mind, and you have a pretty good chance of being able to make dividend payments every year. Right now, with just 1 year under your belt, you're running a little bit of a risk.
Okay.
So that's and I had a friend that ran he used to live across the street from me, but he was president of a Fortune 500 company. And he said when they started paying dividends, that one of the things he always did is he made sure that they saved a few cents from their hit at someplace in the financial statement, so that he'd always be able to kick up that dividend a little bit each time and make it more attractive. So if you're doing 20 million now, you might want to do 22 million and 24 and keep it going. Now, in your case, for this trial, you can do whatever you want to the next go round, because it's not going to have that much overall impact on the market. And again, time to try things. So we were down here, we were in financial statistics. Let's
A
look
quick
at,
question regarding production facilities. So right now we only have facilities basically in North America and Asia Pacific.
yes.
And let's say I want to make a factory in Europe and Africa, or Latin America for that matter. How would I go do that? Do I have to increase the space for production equipment and then
Nope.
it becomes available, or they're locked for the entire game?
You have to, there's a place where you can instruct the game to build the factory. And there's two parts to it. You have to build the factory, and you also have to buy the equipment. And they made a change in the game, and I can't tell you exactly what it is, but it used to be, and I suspect it's the same now, that it takes 1 year to build the factory. So if I start building in year 10, construction takes place in year 11, and the availability of the factory is year 12.
Okay.
And
I've been trying to find it, but I can't find it. So
well, did you know there's a place there where it lists all the different reports, and it tells you it it has a narrative to explain, a help page for each thing, and also videos.
yeah,
Okay, you found that.
yeah.
And if you'd have said, no, I don't know where that is, I don't know that I could have found it for you, even though I was on it earlier this afternoon. But I'm slow. So you have to have both factory and you also have equipment, and both of those get depreciated over time.
Right.
And I've had people get caught with their pants down when the equipment got fully depreciated and the game refused to allow you to make anything on it. And when you're running a factory, the value of the equipment goes down each year, reflecting depreciation. And I'm telling you something here that's of value now. Depreciation is a non-cash charge. It's an estimate of the wear and tear on the equipment. But generally, if you've got regular equipment and you take good care of it, it'll last long after your depreciated value is zero. And what you have to consider, I'd like to use mine up as much as I can if I've got a machinery running in a factory. But what we have to consider is, because of innovation, new equipment gets to be much more productive. And so you have to have an incentive to keep upgrading your equipment so your productivity levels stay up. So it's nice to know that that equipment still will work for you when it's fully depreciated. But don't be seduced into thinking that you don't have to buy new equipment as well.
How often would you suggest we buy new equipment and sell off existing equipment?
Well, I would keep adding to, and I'm moving into an area where I'm weak. So far, everything I've told you, I feel pretty strong about. But in that area, I would keep on replacing. If I lose 20 million in value on my equipment, I want to get another piece of equipment that's going to add 20 million. So I don't ever let that go down. I need to have that productive capacity.
And we were able to see that in facilities and equipment, right? On the
Yes. In fact, let's go down there. I'm going to drop down here. In fact, I would probably skip these other two reports anyhow. At this point, I want to come back to each of them, but I drop down here to facilities and equipment. So this tells me, and now we're looking at a report that'll be different for each of you. But of course, this is, you probably didn't do anything in year one with respect to facilities anyhow, so you're probably all just about the same. But it says here we have factory space available on North America and Asia Pacific of 5 million and 6 million pairs respectively, a total space availability for 11 million. And notice that the current year depreciation on that equipment for North America, and this is in the section right here, is $2,400,000. You're still in good shape with facility. Down beneath that, it has the footwear equipment. Now we can have 5,000 space for 5,000 units, but only be making 2,000. I'm not, I just can't, I'm going to have a hard time making more than 6,000. And that's 4,000. Let's see, I can make 4,000 at 100. I know I can only make 4,800 because using overtime, I could increase my production by 20%. And if my capacity right now on equipment is 4,000 pairs, and I add 20% to that, that's another 800,000 pairs, or 4,800,000. So even then, I can't overdrive the capacity of my facility in this round. Now, Team A made a decision to buy some new equipment and they bought new instead of refurbished. And frankly, I can't tell you what the productive capacity is or the pricing is on new versus refurbished. But one of the key things that we look at is, no, that isn't the one I want to look at. Got to go down a little bit further.
Professor, out of curiosity, you said year 11, company A did purchase brand new.
They purchased equipment, and it could be measured in terms of its the capacity addition. It purchased additional equipment, new, 1,000 or 1,000,000 units, 1,000,000 pairs. They put it all in North America. To do that, they spent $20 million.
Okay, thank you.
Okay. So I think I can't tell you for sure, but I think all they did was put in that number, the 1 million, and it automatically filled in the 20 million here for them because that's based on the price for that equipment. Now, this is the number you got to watch. You got to make sure that that net production equipment reflects the fact that it's still good. And that equipment in Asia Pacific is getting run down pretty good. Well, actually, both of them are getting worn out pretty well. The net available equipment now for the whole company is $70 million. But next year it's going to be worth 55 million because of the $15 million depreciation. And I know there was a question there because somebody was saying something behind me. All right, I'm going to leave this area. The next thing you have to be prepared to do is to distribute the product. You make it in 2 locations, but you can distribute it all throughout the world. And what I'm sure you found is as you try to balance this out, it sometimes can get a little bit squirrely, but you need to make sure that you don't overdrive your inventory and that you distribute the product from wherever it's made to wherever you want to have it made or have it used. And I'm going to beg off on telling you too much more because I don't know too much more. Now, this afternoon, I was looking up the clearance, the inventory clearance. And it shows that you all did, that Team A, Company A, did do some clearance. And I could not figure out why that was the case. And I read through the description of what happens with clearance. And I know when you use clearance is when you get overstocked with inventory, you can offer it into the market at a 25, 50, or 75% discount. And the market's receptivity to buying your old excess inventory is going to be a function of how generous you are with that discount. So if you say, I've got to get rid of this stuff, I'm sitting with 120 days of inventory, and I want to get it down to 30 days, I'm going to have to discount or sell it as distressed merchandise. If I choose a 25% discount, I'll get one level of response. If I do it at 50, I'm going to get a much higher level. If I do it at 75, I can probably close out all of my overstock. And that's something that you're going to have to figure out as you go along. What's the right number? Of course, the best number is never to let that inventory build up. Now, the question might be, how do we keep it from building up? Does anybody want to ask that question? You better ask it quick because I only got 2 minutes left.
I will.
All right, who is that?
Trisha.
Huh?
Trisha again.
Okay, yeah, you got the courage. The goddess.
I'll take
Okay.
any info I can get.
Okay. So the way you do this is as part of your plan for year 12, again, you're going to come up with a your estimated sales forecast and a marketing mix that you think will drive that forecast. So you're going to pass that over to production and tell them, here's how much I need to have. Now production's got to go out and look and see how much inventory they've got on hand and recast their numbers to produce an amount that the combination of what they produce plus the inventory on hand is the same as or close to the same as your forecasted sales. And that way you'll eat into that excess inventory every year before it builds up. And that's, I think, a pretty simple procedure to do that.
Awesome. Thank you.
Okay. Now let's see if there's anything else we want. Again, we're kind of time bound here. I do want to look at this financial statement. And I know you got a different financial statement, don't you? This is the last item in the reports that are available to you. Nobody's talking.
Trying to find it. What exactly we're trying to find? Balance sheet and cash.
We went down here to company operating reports.
Yeah, I'm right there, and we're in balance sheet and cash. And yeah, okay, I'm here.
Yes.
Good.
And this, of course, is we're revealing company's A's position. And I would not do this if we were farther along in the game, but this is still the trial, and we all want to benefit from decisions, good ones and bad ones, and those that are just made on the basis of, I got an idea here, I want to try something. We want to be, all of us be able to benefit from that. But what this shows you is the cash implications of the decisions that you make. And this is a standard, this is not the way I would normally present it, but it is a standard approach showing all of your assets. And the thing I would be watching is this inventory again, because it could really grow. When you get a lot of days in there, you'll find that it's the biggest single thing in your financial statement. It's followed then by the things that are the owners of the assets. That's the creditors and the shareholders. It's able to it gives you a cash flow analysis with your beginning cash, and it works it through to give you an ending cash. And I'm not going to go through the details here. We will do that later on. And I don't know how many of you are accounting majors and how many of you have said, I don't want to touch anything that says accounting on it. But by the end of the time you get out of here, I'm going to show you how you can use the numbers. So we start with a beginning cash, work through to an ending cash. That ending cash is the same as the next period's beginning cash. And you have information here about how liquid you are. And again, I will show you how to do this, but that's going to be down the road. What you can do, however, is to try different scenarios. You can make a decision and see what the results are. Now, I know you do have a thing that shows you what your expected cash flow and what your expected profitability is in the decision sheets you use to input. Am I correct on that? I don't know
Can
how
you
many.
repeat the question? Because I'm trying to.
There is on the input documents that you use, your decision sheets.
Okay.
The last one in there relates to the financial statement.
Yeah, finance and cash flow. Yes.
And it'll show you down in a box in the bottom what your results are going to be based on your decisions without taking into account other people's decisions and how they interact with yours. And by that, I mean, you could forecast that you're going to sell 2 million pairs at $55. And if your main competitor comes in with an offer for offering 2 million pairs at the same price, you know, you may end up creating a little volume, but you ain't going to get 2 million pairs. You'll be getting something north of 1 million, but I can't tell you how much. So it doesn't give you the answer reflecting what the other guys are doing, because you have no way to see that. You have no way to anticipate that. But it will tell you, hey, you're on the brink of having a really bad year based on the inputs you put in there. It'll allow you then to go back and retest with a what if. Well, what if we did a little more advertising? What if we dropped out of that private label market for this round? What if we didn't pay the dividends? We'd have that much more cash available.
Would you suggest, like, I have a lot of or my company has a lot of cash on demand, right? Because I made it so that I have a lot of cash. So I was thinking about just doing stock repurchase, try to get it that way. Or we suggest we do something else.
Well, you can do that, but bear in mind that you want to have cash available to increase your investment in factories and to build a larger balance sheet. If you sell more stuff, you got to carry more accounts receivable. You do have to have more inventory. You are going to
after the fact though, because I already purchased equipment to increase. So then, because I'm really conservative with our cash flow, so I'm trying to, with the excess, trying to get stock repurchase. And this is after already buying new equipment and stuff like that.
All right. Well, if you buy stock, there's a limit to how much you can buy. But if the price of your stock goes up, you can always go back in and resell it.
Yeah, that's what I was thinking.
Okay. So I'm listening to one of the financial experts right now, and he keeps saying, keep some of your powder dry. Keep cash available should an opportunity come along that you don't want to refuse.
Yeah.
Okay. We are over time. You're most gracious to stick with me. And boy, everybody really did. So I want to thank you. One thing I'm going to be doing is I'm not going to be able to be here for Friday. I'm going to miss my class on Friday. So what I'm going to do is record a Zoom meeting for them covering the same thing that we covered today. And they'll be able to see this. I will be able to get that out and put it on Blackboard, and I'll probably put it on all 4 classes. So it's something you can go in and take a look at just to review what we've been talking about. Okay?
All right.